For real estate decision makers, the time for posturing, reassessing, and recalibrating business strategies has passed with the cold, dark months of winter. Should all go as planned, 2021 should be a breakout year and the start of a new economic cycle of prosperity. Hi, my name is Mel Giannone. I'm a commercial real estate broker serving entrepreneurial companies and individual investors seeking property across the Greater Toronto Area. Welcome to CRE Next, Work Out Loud. Here's what happened this week in CRE. Hello, my name is Mel Giannone, and I want to welcome you all back to the latest edition of CRE Next, Work Out Loud. The idea behind these episodes is to share my everyday work thoughts on real estate out loud with you. I tailor the content for real estate strategists seeking insight into the current commercial real estate market for the Greater Toronto Area. So if you play a role in real estate for your company or transact in commercial real estate personally, then I invite you to help grow this online community with me. Let's work out loud together. In today's episode, we're sharing some of the contents from one of our most recent client newsletters that covers current economic conditions and the latest commercial real estate stats for the Greater Toronto Area over the first quarter of 2021. To get a copy of the newsletter, called the Prep Sheet, an acronym abbreviating the name of our company, Paramount Real Estate Properties, please subscribe on the homepage of our website at paramountrealestate.ca. If you find any value from our episodes, we welcome your comments, likes, encourage you to subscribe, and tap the notification bell so that you don't miss out on any new content as soon as it's released. Lastly, if you know of anyone who would be interested or can benefit from these episodes, please feel free to share the link with them. You can also find us on other social media channels like Facebook, Instagram, Twitter, and LinkedIn, as well as in audio podcast versions of the show called CRE Next, Work Out Loud. I look forward to connecting with you on these platforms as well. As always, to make sense of it all, we'll break this episode down into two parts by looking at the current macroeconomic picture and then turn our focus on a more micro level as we touch upon statistical trends for office, industrial, multifamily, and the investment sectors of our local market. Let's get into it. The Canadian economy, 2021 could be a breakout year. Despite the initial shock and immediate bounce back in the economy by the fall of 2020, the last third of that year up until now has been a slow climb back towards pre-COVID activity levels. Government-mandated restrictions, shuttered vaccine availability, and interruptions to supply chain distribution had obstructed general market recovery throughout 2020. Optimistically, there has been positive momentum carried forward into 2021 as mass vaccination efforts continue and economic visibility grows clearer. As of the end of the first quarter of this year, Canada's economic recovery stood within 1% of real GDP levels observed in February of 2020. We've leveled off over these past few months, but still poised for accelerated expansion. Given the federal government's latest budget, which included extending certain support programs and launching new investment initiatives intended to boost our national GDP and raise employment levels. Canada stands to benefit from infrastructure investment on both sides of the international border and demand from China for commodities as their economy launches forward. Domestically speaking, the Bank of Canada will continue executing its current monetary strategy at least until 2022. They'll monitor the flow of investment capital with a focus on maintaining low borrowing costs, softening market volatility, and keeping inflation in check. For real estate decision makers, the time for posturing, reassessing, and recalibrating business strategies has passed with the cold, dark months of winter. Should all go as planned, 2021 should be a breakout year and the start of a new economic cycle of prosperity. As we had predicted last year at this time, past economic downturns suggested an average between 1 to 2 years would pass before the start of a new, sustained economic cycle, lasting roughly a further 8 to 10 years. Given the current momentum, Canada should absorb the remaining 1 to 2% slack in the economy within the second half of 2021. That's when we should expect to land back at February 2020's pre-COVID levels of GDP, a completed recovery in many respects. Overall, the first quarter saw gains in 15 of 20 sectors that contribute to the growth of our GDP, the third consecutive quarterly increase. By technical definition, Canada came out from recession back in Q3 of 2020. The latest increase in GDP for Q1 2021 reflected continued strength for the economy, influenced by favorable mortgage rates, continued government transfers to households and businesses, and a slowly improving labor market. We expect economic activity to flatten out a little bit in Q2 before taking a slightly sharper upward trajectory to complete the year on a high note. We're almost certain of this because 2021 is a federal election year, and it would be a reasonable expectation that the current government will allow the economy to run hot until after the votes have been casted. If all goes well this year, barring any more successive waves of infection and accompanying shutdowns, the next decade cycle, commencing late in 2021, could have great potential. The millennials will take the lead in driving the economy going forward, just as the boomers had done over the last 60 years, greatly influencing every aspect of life from vehicle purchases to housing demands, stock market investments, memberships to gyms and sports clubs, to influences on fashion styles, music, pop culture, and politics. I honestly have hope for the smallest possibility of declaring the world pandemic over by Canada Day or 4th of July weekend. Wishful thinking? I'm optimistic that the reopening of the economy is at hand and that we'll begin to see more frequently the positive signs of a sustainable recovery. I'm not the only one that shares that sentiment. The Bank of Canada had revised its growth forecast to 6.5% for 2021. That's 2.5 points better than was initially forecasted back in January. In an announcement made April 21st by Governor Tiff Macklem, the Bank of Canada revised its guidance towards a potential raise in policy rates, now moved up to 2022 from 2023 because of a better outlook. The Canadian monetary policy would be tightened to purchase $3 billion per week in government bonds as of April 26th. That's down from $4 billion. So as real estate strategists, what should we be keeping a close eye on in 2021? Well, take off those rose-colored glasses and focus on early transitory inflation. We're not completely out of turbulent times just yet. The Bank of Canada's quantitative easing fiscal policies, along with federal government monetary stimulus programs, have injected a lot of liquidity into the Canadian economy. A big chunk of that money had a side effect of creating asset bubbles in the stock market, housing market, precious metals, and cryptocurrency. Inflation of the money supply not only bumped up the overall consumer price index, but contributed to price jumps in the commodities price index, the industrial product and raw materials index, and leaps in the price index for building construction. All shot up rapidly in the first quarter, making the cost of goods and services rise faster than earnings. Overall prices for domestically produced goods and services rose 2.9% in the first quarter, while growth for compensation of employees lagged behind at 2.1%, and household disposable income, although it rose, was at 2.3%. The net result of this transitory inflation was an erosion of household purchasing power just a little bit between March and April of this year. Meat, fish, and dairy products up 4.1%. Fresh and frozen beef and veal up 17%. Fresh and frozen pork up 7.3%. Q1 construction costs for residential buildings rose 15% in Toronto and 5.6% across Canada. That's an 11.7% year-over-year increase. Townhouses rose 6.9% across Canada in Q1. Single detached houses rose 6.8%. That's a 14.6% year-over-year increase. All these sectors rose faster in Q1 than compensation of employees and household disposable income. Non-residential building construction in Canada rose 1.5%. Office buildings up 1.2%, warehouses up 1.8%, and factories up 2.1%. These are all watershed statistics pushing costs to new levels, and although we expect the tide to recede back a little by 2022, the lasting watermark will remain with us indefinitely, as these costs won't get absorbed completely by businesses, but rather passed along to the end consumer to preserve those profit margins. The one redeeming feature from all this stimulus is that the personal savings rate among Canadians still remains at 13.1% in Q1. So, any transitory inflation would be temporarily affordable, offset by the release of those stored dollars in people's bank accounts and willing appetite by Canadians to spend regardless of the increase in costs. These are the effects, both good and bad, of government-mandated economic stimulus. We've averted another financial crisis by over-medicating and pumping up the economy on steroids, but it will soon be time for the government to make that decision whether to take this patient off life support and reveal what lasting damage may have been caused. Although the loonie's value had taken flight against the US dollar since the rebound of March 2020, it hasn't kept pace with real rising costs. The illusion of a strong Canadian dollar only exists when measured against a weakening American greenback. This poses a problem for the Bank of Canada. Do they raise policy rates, thereby further strengthening the loonie, or let inflation run hot by holding rates in place until the US decides to do the same? Both the Fed and the Bank of Canada have adopted relatively the same strategy up until now, so I'd have to bet on the latter scenario supporting further synchronicity. If the Bank of Canada falls out of rhythm with the US, our cost of exports to our southern neighbor will fall out of favor, being too costly. So here is this month's takeaway. The transitory inflation we're experiencing in the first half of 2021 has been caused by the simultaneous rise of the following factors: monetary stimulus via low interest rate environment, fiscal stimulus via government spending and transfer payments, positive momentum in economic activity from a recovering economy that instills confidence, and the release of pent-up spending previously hindered by recurring lockdowns. As a result, an accumulating effect in aggregate demand temporarily spikes up prices and places upward pressure on production costs. It's transitory inflation because going forward, aggregate supply will play catch-up. Production will come back online towards peak capacity, and a full allocation of resources will be deployed as labor is allowed to return free from shutdowns. It will take until 2022 before the lag in supply matches demand. Right now, the amplified costs look concerning, only when measured against the yearly base effect, that is, measuring inflation relative to last year's bottom economic levels as the denominator or the base. So as we anticipate a leveling off of costs over time, use this time now to invest in real estate as a hedge against inflation and negotiate and/or renegotiate your company's real estate leases now for the long term, so as to prepare your business for the start of the next new economic cycle. So now let's talk about which types of commercial real estate have thrived through the first quarter of 2021 and where the opportunities might be going forward. The office market. New work paradigms mean low absorption rate for office space. 2020 saw the influences of a pandemic alter market fundamentals for all types of real estate, but the office asset class was particularly hurt more so than certain types of retail. Traditional workplace models have given way to a more distributed workforce and flexible work scheduling. In Q1 2021, the office market had continued to be defined by stalled demand, increased supply from construction completions, a flood of sublease offerings, lapsing lease expiries, short-term renewals, softening rental rates, and landlord flexibility towards business terms, incentives, and concessions. Most tenants had taken 2020 to work on footprint optimization, navigating safe re-entry for employees, and operational planning. It'll take a few years of renewed demand for the absorption of all this excess office space to return to 2019 levels. Although vacancy rates are in double digits across the GTA, Toronto's downtown market still has the lowest availability rate among comparable markets in North America. We are now starting to hear that most companies will call back their employees to the office by September, and we are experiencing early signs of positive absorption in certain submarkets as tenants make renewed commitments with their landlords. We've likely bottomed out from the bottom of 2020, so you may want to negotiate or renegotiate the business terms of your lease before conditions return towards a landlord's market for office space. The industrial markets, insatiable year of demand from industrial users. Uninterrupted by the effects of the pandemic, the industrial asset class remained resilient throughout 2020, as a significant portion of industrial tenants were deemed essential. Demand for industrial space was only pushed higher with the increased adoption of online shopping, e-commerce, and the expansion of distribution networks. Average asking net rental rates have increased over the $10 level, which represents more than a 10% rise year over year, over 50% from 3 years ago, and approximately 65% over the last 5 years. Much of the GTA is experiencing double-digit asking prices, with the highest rents found north of the city and the cheapest in the east end of the GTA. Overall, availability will remain in the low single digits for 2021, as supply of new product won't keep pace with increasing demand from warehousing, logistics, film studios, food and beverage companies, household and consumer products, as well as click and deliver type retailers like Amazon, and direct-to-consumer retail brands. Available options will be slim and quickly absorbed, so prepare up to 1 year in advance to move into larger blocks, particularly those blocks of space above 50,000 square feet. Multifamily residential. Rents have bottomed out, now awaiting the immigration tsunami. The scare of a worldwide pandemic throughout 2020 had repercussions on the multifamily asset class. Future demand towards home ownership was accelerated forward by a few years, sparking a significant exodus of renters from densely populated urban cores. The lack of annual rental demand from students, immigrants, and non-resident workers had pushed GTA vacancies up beyond 3% to its highest level in 14 years. Purpose-built apartment buildings were competing head-to-head with condo apartments, a large portion of which were formerly short-term rentals or Airbnb. It was the condominium rents that suffered the most, with rent declines of almost 10% year over year, while purpose-built apartment buildings experienced an increase in rents just shy of 5%. Price point had a lot to do with shifting demand, as prestige buildings in both rental types suffered the most, as monthly rents north of $2,500 were at parity with home mortgage carrying costs for townhomes and single-family homes in select suburban markets. Rent collection levels for apartments were above 95% throughout 2020, which made this asset class attractive for investors. Going forward, planned rent freezes for 2021 will mean rent-controlled suites will not have the benefit of adjusting rates upwards until government COVID policies change. Rents have bottomed out in Q1 2021 as the pendulum swings back from aspiring home ownership to slightly more affordable rental apartments. We could expect demand for larger units, greater than 1 bedroom plus den, will see the biggest immediate rise. Commercial real estate investment markets are on the early rebound. The Greater Toronto Area Q1 2021 market saw the largest first quarter year-over-year jump in investment activity on record. Over 600 transactions totaling over $6 billion equated to a 56% rise in value over last year's opening quarter. Land was a big winner in Q1, representing over half of the value in transactions of approximately $3.2 billion. Industrial assets were next best, representing $1.4 billion and approximately 23% of transaction value. Multifamily and food-anchored retail strip malls ranked next in demand with transaction values at very similar levels to each other. Office was the lone asset class to see a decrease in transaction volumes in Q1 by approximately 18%, while hospitality assets saw a glimmer of hope in bouncing back off its investment demand lows. As the Bank of Canada announced it would begin to taper its quantitative easing bond purchases to $3 billion a week starting April 26th, we saw a preemptive rise in the Bank of Canada 10-year benchmark rate by the end of the first quarter of 2021, placing some upward pressure on interest rates, but not enough to draw the big money out of the stock markets, precious metals, and cryptocurrencies altogether. Still, by the start of the second quarter, a large allocation of portfolio funds dedicated to commercial real estate had yet to be deployed by institutional investors. We saw capitalization rates in the GTA compress slightly and trend relatively flat throughout Q1 as investors cautiously negotiated the bid-ask gap between buying and selling property. The overall average cap rate expectation across the 4 major food groups, office, industrial, multifamily, and retail, sits just over 4% and should remain in that range at least until mid-year 2021. Well, that's all for this episode. Hopefully you found some entertainment value in the data presented here, along with the insight into current market conditions, trends, and knowing what the future might look like. My goal is to help you save or make a lot of money through these episodes of CRE Next, Work Out Loud. Please don't forget to sign up for our free client newsletter, The Prep Sheet, found on our homepage of our website. We humbly ask that you like, subscribe, and tap the notification bell so that you don't miss any new content as soon as it's released. If you know of anyone who could benefit from these episodes, please share so we can grow our community. You can also find us on other social media channels like Facebook, Instagram, Twitter, and LinkedIn, as well as in audio podcast versions of the show. I look forward to connecting with you on these platforms as well. Thank you for your time. For real estate opportunities together, I can be reached by telephone at 905-567-5602, by email delivery to mel@paramountrealestate.ca, or communicating through the comment section if you're watching by video or listening via podcast. Until next time, stay well.